Okay, for lesson 42, I just want to spend a few minutes going over some examples of free response questions that I assigned you in your packet or in your assignments. I want to do this because these questions about the applications of the exchange markets are so common in the free response section that I think it's worth spending some time just making sure that we're all on the same page. So let's start with the one I assigned you from AP Free Response question 2002, number 3. Hopefully at this point you've already made an effort to try the problem, and now we're just working through it together to make sure that we got the answers right. Okay, let's examine the question first. It says initially the real interest rate in the US and Japan are equal to 7%. The real interest rate in the US increases to 8%, while the real interest rate in Japan decreases to 6%. All right, so the US and Japan are equal to 7% initially, but the interest rate goes to 8% in the US and decreases to 6% in Japan. Question 1. How and why will capital flow be affected by this change in real interest rates? Okay, which direction is capital going to move? Well, in this case, remember, higher interest rates mean more money is going to come your direction because people want to put money in investments that are going to make the most interest. So in this case, the US, its interest rates rose to 8% while Japan's dropped to 6. And so money will flow toward the US. And again, the explanation, if they had asked, that you would want to give is because the US's higher interest rates make US financial assets more attractive to investors. They're better investments because they return more interest. Okay, looking at part B, it says using a correctly labeled graph of the yen market, show and explain how the value of the yen will change relative to the dollar. All right, so that we need to have a market for the yen. So we have the quantity of yen in the US there on the x-axis, and the exchange rate, which is really the price of the yen, which is the number of dollars you get for the yen. So what we'll do now is we're going to draw in your supply and demand curve, and of course label our initial equilibrium, exchange rate number 1. All right, now it's asking us to say how will the yen market change because the US interest rate has risen to 8% while the Japanese interest rate has lowered to 6. Well, what we know is that the US demand, the demand for the dollar is going to increase. Why? Because the dollar has a higher interest rate associated with it. Now remember, if the demand increases for one currency, it also means then as someone demands that currency, they must exchange their own currency. So what that means is the supply of currency will increase. The supply of the yen will increase in the US as Japanese people are buying up US dollars. They have to send Japanese yen to the United States, and therefore the exchange rate will decrease, and therefore the value of the yen will depreciate. Now, by the way, you could also have said a decrease in the demand for the yen. That also would have been acceptable. But either way, the key thing is to make the note that the exchange rate is decreasing and the value of the yen is depreciating. Okay, so part C says, explain how the change in the value of the yen that we just identified in part B, and we decided that the value of the yen depreciated, will affect each of the following in the US. US imports and US exports. All right, well, how will that affect it? Well, remember, if the yen has less value, that means that every Japanese good is essentially cheaper to the United States, which also means that every United States good is more expensive to the Japanese. And so the answer, imports from Japan to the US will increase because Japanese goods are cheaper. But the US exports to Japan will decrease because US goods are relatively more expensive. Okay, that wraps up AP Free Response question 2002, number 3. Let's try to walk through one more that I assigned you. And again, I'm hoping that at this point you've already gone through the question. And we're just making sure that we have a good handle on things. All right, I'm going to go through part A of this question very quickly because it's really review and not a part of this module. But quickly, the information we have on the question says, assume that an increase in government spending increases the budget deficit in country A. Now, part A says, using a correctly labeled graph of the loanable funds market, show the effect of the increase in country A's budget deficit on real interest rate. quickly, I'll put up here, we remember the loanable funds market, the quantity of loanable funds, the real interest rate represented by the letter R, and we know that if we have a budget deficit, that there will be a decrease in the supply of loanable funds. That was from last unit, and that will cause interest rates, real interest rates, to rise. And that would, of course, be full credit for that question. That's going to be important in a little while. Okay. Again, we have this part here that says we have an increase in the budget deficit in country A. And as I move on to part B, it says, given the answer in part A, what is the effect on the business investment in country A? Okay, again, this is a little bit of review, so we'll go quickly through this. But the higher interest rates we identified in part A are going to result in it being more difficult for businesses to invest in things like equipment or factories or plants because those interest rates are higher. So it's much more difficult for them to get loans, to borrow money, and much more difficult for them to invest in those sort of things. And essentially the answer is business investment will decrease. And again, that's a bit of review. Okay, part C, the last part of the question. The exchange rate between country A's dollar and country B's peso is determined in a flexible exchange market. Just as a review, flexible exchange markets we always assume unless we're told otherwise. And generally I've never seen a question at this level where it wasn't a flexible exchange market. Using a correctly labeled graph of the foreign exchange market for country A's dollar, show how the interest rate change you identified in A affects the international value of country A's dollar. So we identified in part A that country A's interest rate rose. And what do we know about interest rates? We know that if your interest rate rises, people will want your currency more. So if I graph this, it should look something like that. The demand, on the x-axis, we should have the quantity of dollars. This is the market for dollars. In this instance, the price of the dollar is the number of pesos per dollar. And because of the higher interest rates, there is an increase in the demand for country A's dollar. A shift to the right, and that, of course, increases the exchange rate or appreciates the value of the dollar. Okay, please continue with this lesson by doing the final free response question.